It is the week of October 31st. We're entering the month of November. I'm Will Woodall, joined as always by Mike Rarey from STRAT. Hey, Mike, how are you doing today?
I'm doing well, Will. How are you?
Great. Did you have a successful trick or treat yesterday?
You could say that. Kids petered
Awesome.
out at about 6:30, which was perfect for me.
And the question all the viewers probably want to know is how much of the candy did you actually eat?
The good news is they brought home a lot of peanut butter candy, and so we know I can't eat that.
That's no bueno for Michael.
Yeah.
All right. Well, it's been an interesting month, probably a really good month for risk assets in October. So we're going to talk about the risk assets and the performance of all asset classes for October. We're going to look at updates to liquidity, inflation, and recession and growth factors. And then we've got some interesting data on the housing market that we're just going to tease you with because we've got a really comprehensive deep dive that we'll be doing in the next few weeks on the housing market since there's a lot going on there. So, Mike, let's start with equity prices for the month and pull the board up here and look at this incredible month we had.
Yeah, very solid October. S&P 500 up a little over 8% total return basis. And you look down the board and you see value stocks generally outperforming growth stocks during the month. Large value up over 10%, small value up over 12.5%. So definitely, bear market rally 2.0, if you will. If you recall, the first bear market rally we had was mid-June to mid-August, and the S&P rallied about 18% from its lows, but it was really driven by growth stocks. And this one's a little different. So the market has rallied a little over 9% from its lows, mid-October, a couple of weeks ago, but it's been driven by value stocks. Energy, financials have definitely been the outperformers.
And is this type of bear market rally where we've got this sort of different leadership in this bear market rally? Tell us anything about the nature of it, if we're forming a bottom, et cetera.
So in terms of the leadership and the changing leadership, it doesn't tell you a whole lot. It kind of tells you that, the stocks that are rallying in bear market rally 2.0 were the ones that were maybe unloved coming out of bear market rally 1.0. And so, what's still cheap, what's left, those get a bid. But more so the magnitude and the number of bear market rallies. This is not uncommon. It's quite common that in long bear markets, you get multiple rallies of 10% plus within that bear market. And so this is still par for the course. We're still calling it a bear market rally.
And I guess the other factor is rates did rise during this period. So the growth stocks, that led to some of the growth stock underperformance. And we can see that on the next chart where fixed income also did not have a very good month.
Yes. U.S. Treasury is down a little over 1%. Most of those losses came from longer duration securities. And what's starting to happen now is something we've been talking about for a while, where at the shorter end of the Treasury yield curve, yields are topping out. But even if they go up a little bit, the losses that come from yields rising are almost all being offset by the very attractive starting yields you have, just the higher coupon payments. So if you look at the 2-year Treasury, for example, only down 19 basis points, which I know that's nothing to get excited about. But compared to what we've experienced year to date, it's starting to tread water. The attractive starting yields you're getting are offsetting rises in interest rates. So that's exciting if you're like us and you look at these things, daily. That's an exciting development.
Yeah, I mean, you're getting 4% yields in some of these treasury bonds. So that's a really nice starting yield in some cases.
Yep.
So let's move to alternatives, sort of a mixed look here. Energy definitely did well, but softs in particular, maybe you can speak to that and how their performance was so hurt this month.
Yeah, I think softs, think about like coffee and then also cotton and other textiles. Down quite a bit. There are a lot of weather-related factors here. They don't make up a significant portion of the overall commodity index. You can see that basically as energy and grains go, the index goes. They're the biggest weights. So, tough month for softs, but really doesn't change the overall outcome there, with commodities still up 2% and still up over 15% year to date.
Yeah, so we're still seeing food inflation, right? I mean, that's sort of we haven't seen that sort of drop down significantly yet. And if we move to our inflation forecast on the next chart, I think let's talk through this in a little more detail, what we saw during the month and the core versus headline numbers. And then I guess also just comment on our forecast, which has been generally, pat ourselves on the back here. It's been pretty spot on.
Yeah, the headline forecast, definitely. That's where we might hurt ourselves, patting ourselves on the back. The core forecast has definitely evolved, but basically high level here, we were in high and rising inflation on a headline basis. That's the blue line. That includes food and energy prices year over year. That we feel very confident we're moving into high and falling. That's good. That's been enough here to sort of slow the rise in treasury yields, despite everything that's happening on the short end of the yield curve. But that's certainly playing out, and due to base effects and other factors, we think that it's likely over the next 12 months that headline inflation year over year is going to continue to fall. Core inflation continues to be frustrating for the Fed, and our forecast, which has evolved throughout the year, looks like we're going to be plateauing all the way until about next February, which, coincidentally or not, that time horizon corresponds perfectly with when the market thinks the Fed will do their last rate hike of this cycle. That'll be the last time the market thinks right now the Fed will have to hike, because from there on out, core inflation should start coming down at a decent clip. Still, probably not fast enough, but at a decent clip.
Right. I think all those headlines during the month, which led to some of this rally, was this Fed pivots going to be happening. This would suggest that that's not going to be happening anytime soon. So, in terms of the core versus the headline, just refresh the viewers why the Fed focuses more on core than headline.
Yeah. So headline, so that includes food and energy prices, and food and energy prices are very volatile. They're very difficult to predict, and they're generally not sticky, meaning food and energy prices can go up, but they can also go down. What the Fed worries about more are the elements of core, particularly things like shelter and medical costs. Those are the sticky, unavoidable expenses. So sticky from a standpoint that very rarely do shelter prices go down meaningfully. Once they start going up, sort of the best you hope for is they just stop going up, but very rarely do they go the opposite way. Same thing with medical costs. Very rarely do medical costs go down. And these things are largely unavoidable. You can buy fewer used cars for sure. You can cut back spending in certain places, but if just the cost of shelter is going up and medical costs keep going up, that's just a tax on everyone. And when people have to pay those expenses, they consume less elsewhere, and that slows economic growth. So that's why they're particularly worried about those elements of core.
Yeah, great points to lay out there. Let's move to liquidity. Again, this is a chart that we've projected out. We've shown it many times. I think the power in this chart is that we've been generally right in the liquidity forecast, and we're showing that it is still decelerating at a pretty rapid pace, and will so for the next several months before it bottoms.
Yep. And you see all these things start to line up. So our liquidity forecast, you notice that it bottoms right around February, March of next year. That's also when core CPI is expected to top. And so, of course, when both of those things are happening, you expect the Fed to stop hiking. And so we see that in our liquidity forecast. And then you see something that you shouldn't get too excited about, but you see in our forecast horizon liquidity on a year-over-year basis start to come up slightly. And the reason for that is once we get to the back half of next year, the expectation is the Fed might cut the federal funds rate about 0.5%. And so this is what you were speaking to earlier, the idea of, all right, well, the Fed should be slowing hikes, and maybe they might even talk about, as we get into next year, a pivot in the back half of next year. Raising the Fed funds rate to 5% and then cutting by 50 basis points is not a pivot. We just want to reiterate that. That is not a pivot, because you can see that on the chart. Okay, when we look at pivots in the Fed funds rate, we look at 2018. Look at the year-over-year change in money supply growth. Look how it starts to come up. And what was that? That was aggressive cuts. That was going from quantitative tightening to stealth quantitative easing. That is a policy pivot. So what would we need to see from the Fed back half of next year? Yes, 50 basis points and cuts is a good start. You're probably going to need to cut more than that for us to get excited about a real pivot. And you're also going to have to stop reducing the size of your balance sheet and maybe even start increasing the size of your balance sheet. Those things would get us more excited about our liquidity forecast.
Yeah. So before we tease the housing information we've got here, we did have GDP come out. Talk a little bit about that number. That was also part of some of the narratives around why the market was rallying, because it was a good number. Just give us a little headline on that. We're going to do a deeper dive on that in a coming week or two.
Yep. So Q1 and Q2 were negative on a quarter-over-quarter basis, real GDP growth. Q3 was positive. And that positive sort of came out of nowhere, really the last month of the quarter. And it was positive 2.6% quarter-over-quarter seasonally adjusted annualized. So that's pretty good. That's exciting, right? On face value. If you look under the hood and you look at contributions to the growth number by sector, what you see is virtually all of the growth that we saw in Q3 came from net exports, which were, not as bad as everybody thought they were going to be, and inventories, the inventory drawdown being not as severe as everybody thought they were going to be. And a lot of this was largely impacted by US dollar strength. So foreign currency translation, and then the fact that, the US consumer is spending less on a real basis, just as much on a nominal basis because of inflation. And we're just buying fewer things. And so if you look at net exports, exports minus imports, well, if imports are smaller, then net exports contributes more to GDP. And so this is something you could get excited about. But the reality is we're just buying fewer things. It's not like we're exporting more. So under the hood, the overall trends that we're seeing in the economy have not really changed. This is not a game changer number for us. We're sharpening our pencils and revisiting our forecasts. The underlying fundamentals we've been talking about here, low and falling liquidity leading to low and falling economic growth, that's still playing out.
Yeah, I think that's super important for us to illustrate. And when we do a deeper dive on that, we'll illustrate exactly what Mike just was referencing, so you can see how it fits into our forecast for the next several quarters, where we see things continuing to decelerate GDP-wise. All right, let's throw up the housing prices heat map. We're doing a project for a client, and we thought we'd share some of the output as a result of one of the components of the project, which is to look at regional housing prices and how they've been trending. So let's throw up the map, and Mike, take us through here what we're seeing around these regions.
Yeah, we're taking all of the metro, regional, and then put it up on the highest level national data from S&P, CoreLogic, Case-Shiller housing price indices. And all of these numbers are the 3-month rate of change. So they obviously come out and it's month over month, and that's super volatile to look at. So we look at 3-month change, 6-month change, year over year, so on and so forth. And what we've had on a national level, you see all the way up top right, in August, the 3-month change is negative. That's because July and August were our first 2 months since the pandemic that we actually had month over month declines in home prices. And there are some interesting trends here as you look down to regions and metros. You can see the overwhelming majority of the price declines are in the West, particularly if you look all the way at the bottom right, Seattle, San Francisco, San Diego. And then if we showed more data here and we looked into price tiers, it's primarily the high price tiers where prices are coming down, almost 10% over the past 2 months in the West. That's driving the overwhelming majority of it. If you said the housing market was slowing or house prices are coming down in the South, most people would be like, what are you talking about? So it's quite different based on where you're at.
Yeah, absolutely. And what does this sort of portend for prices going forward as we've seen mortgage rates continue to rise here, and we expect them to continue to rise?
Yeah, so it's good you drew that link because no doubt this is caused by rising mortgage rates. I mean, rising mortgage rates have frozen the housing market, and they've priced out buyers and they've priced out sellers. Who would want to sell their house if they have a 3% mortgage outstanding and then have to go buy something with a 7% mortgage? So it's no doubt mortgages. And also just reiterating how this index is constructed, it's a repeat sales methodology. So you start to think about what is actually happening here. That means like someone bought a house and then they sold it. And so now it's a repeat sale, and what they sold it for was lower than what they bought it for, right? But if you look at the trajectory of housing prices, if that were to happen in the West, that basically means someone had to have bought a house like 3 months ago and then sold it right now. This has to be hot money stuff. Because if you bought your house 6, 9, 12 months ago, you made money if you sold last month, most likely, on that repeat sale.
Right.
So you had to have basically bought at the top, and with hot money, I don't know if it was crypto money, it doesn't matter, whatever it was, and now you're having to get out, right? That's basically what's happening. So it's not super concerning, but clearly some people regretted the purchase that they made in May or June.
Yeah. And then just for the viewers who are interested in the housing market data, just give us a little teaser on what we're going to be looking at in future weeks here.
But yeah, so we want to take a lot of this data and tie it back to one, our framework. Why is this happening? Two, how bad could it get? And then three, understanding that home equity is a significant portion of wealth for the middle class and upper middle class in particular. And so, what does that mean for wealth accumulation in the country going forward if the housing market is basically frozen for as long as the Fed keeps rates high? And that has some implications.
Yeah, great. Well, stay tuned for that in the coming weeks. But in the meantime, before we look at recession, there was quite a bit of chatter about some comments Jerome Powell made regarding the yield curve spreads that he looks at in terms of what's important in determining whether he should be hiking or cutting rates and whether we're going to have a recession or not. And so we put together this chart, and we're going to talk a little bit about the three different markers that we've historically used and what the Fed's looking at here in terms of yield curve spreads. But first, maybe just define what a yield curve spread is.
Yeah, a yield curve spread, you take the yield at one maturity point on the Treasury yield curve and compare it to another one. And generally speaking, longer maturity Treasury bonds should have higher yields than shorter maturity Treasury bonds. That means, economic growth is going to be positive, inflation is good, yada, yada, everything's healthy. When they invert, that means the market is expecting something not so good. They're expecting that while short-term rates are higher than long-term rates, that must mean that economic growth is going to slow. The Fed has raised short-term rates too much, and they might have to cut in the future. So that's why everybody pays attention to yield curve inversions. When a shorter maturity Treasury yield is above a longer-term maturity Treasury yield, that means bad things might be happening in the future. And we have three of them. These are the trifecta of yield curve spreads, if you will. The first is you take the 10-year minus the 2-year. When that's negative, meaning the 2-year is higher than the 10-year, that's a bad thing. Now, this was the Fed's preferred yield curve spread that they looked at to try to see if the market was predicting a recession way back when. They don't really pay attention to this anymore. They came out with more research in 2016 saying, no, 10-year minus 2-year, which you can see is clearly inverted right now and has been for a while. That's not what you should look at. You should look at the 10-year minus the 3-month. That's a better indicator. Well, that's now inverted. So then earlier this year, Jerome Powell was asked in a press conference, hey, the 10-year 2 years, this was in March, the 10-year 2 years steeply inverted. Are you all worried about this and what this means for recession? And he said, no, you shouldn't focus on that. And you shouldn't even focus on the 10-year 3 month. You should focus on these near-term forward yields. And so that's this light blue line. And so this is research that the Fed recently updated in February of 2019 that said you should look at what the forwards market thinks the 3-month Treasury yield is going to be in 18 months versus what it is today. When that's inverted, that means bad things for economic growth. It's a better predictor of recession than all the other yield curve pairs we've ever looked at. And that's what Jerome Powell says they were really paying attention to. Well, now here we are 1 day from the November Fed meeting, and it inverted. So it briefly went negative on October 27th. Right now, it's slightly positive, 15 basis points, but cannot wait for one of the reporters to ask him the question again and see what he has to say, right?
So just translate that into numbers. So the implied, the current 3-month yield, I don't know what it is this moment, but this would suggest that the implied 3-month yield in 18 months is pretty much in line with what the current 3-month yield is, right? And if it inverts, it would suggest that it would be higher.
When it inverts, it suggests that basically the Fed is going to cut rates 18 months from now.
18 months from now.
So yeah, the current 3-month is higher than what it's going to be in 18 months. That's basically what it would say.
Yeah. So these are all, I think, interesting ideas. I don't know if it's what it tells us in the details, but all directionally point to the fact that recession probability is probably still rising, if not becoming more certain. So maybe we throw up the recession probability. Not much change this month, probably due to the market factors, I would guess.
Yeah, the bear market rally has reduced the probability that we're in a recession right now, but still the longer term, 6 to 12 months out, above 50%, that hasn't really changed. So nothing crazy, just really right in line with everything we're seeing out of liquidity, out of the yield curve, out of the housing market. So all consistent.
Great. Well, let's take some questions. I know there's a couple in the queue. Oh, I think we touched on this a little bit, but it's always good to reiterate when people say inflation is sticky. So maybe just hit on what that means again.
Yeah. And what makes inflation sticky? Well, certain types of goods, inflation is sticky. I don't know if any of our viewers have ever, put multiple kids through college and saw, oh, actually, the fourth one I sent to college, college tuition went down. It's great. Like nobody's experienced that, right? Because college tuition is an example of a service that has sticky inflation. Generally, when costs of tuition go up, they're not going to come back down. The toothpaste is out of the tube, the genie's out of the bottle, whatever you want to say. So for certain items, inflation is sticky. For other items like food and energy prices, it is not sticky. Used cars, for example, that is not sticky inflation. Used car prices can go up, they can go down. They're based on market factors, they're commodities, things like that. So yeah, a lot of the goods in the core basket are sticky. And so the longer you let inflation happen, if you're the Fed, the more you run the risk of a price spiral of everybody increasing their expectations for college tuition. And now, if before I thought college tuition was going to go up 5%, and now it's going to go up 10%, well, now I need to save more money. And it has all these knock-on and ramifications for, consumers and spending and savings behavior.
Yeah. All right, next question. L-shaped recessions. There's all sorts of alphabetized recessions, U-shapes, V-shapes. Talk about the L shape and what we think about L-shaped recessions.
Yeah, what it usually means is before we go into any recession, everybody says it's going to be L-shaped because they almost could never see the way out. But what everybody said this about COVID as well, right? As soon as we went into COVID, oh, this will be an L-shaped recession, implying we're going to have a really sharp drop in economic activity with no real recovery to speak of. it's kind of like I'm just going to have a cold for the next 2 years. It's just not going to feel great, and I'm not going to recover. Something like every fall when my kids go to school. I'll probably feel like that for the next at least 3 months. But so that's what an L shape looks like. There aren't many historical analogs for an L-shaped recession. They're always feared, but the reality is we get a big influx of liquidity as the Fed pivots, or we get fiscal stimulus, or we have these buffers built into our economy, things like unemployment benefits, that create V-shaped recessions.
Yeah.
That's usually what happens, and it's just the slope of the second leg of the V. Is it straight up like COVID was, or is it sort of more drawn out?
Yeah, like the financial crisis recession was more drawn out, but we don't have a lot of recessions to draw from, so everyone is a little unique in how it gets played out on the back half of it. So if you want to alphabetize it, that's fine, but I think the better idea is once we get in it, what's the response, and how efficient will the medicine be at correcting what ails the economy. So next question. What is the worst case scenario for the housing market? How bad can it get? I guess that largely depends on where you live, perhaps, but maybe talk in general terms and then bring it to the regional case.
How bad could it get? I guess the worst housing crisis we've ever seen was 2008. We think it's unlikely that any decline in housing prices we see this time around would be anything near that, because the cause is totally different and the risks are totally different. Now what we're looking at is most people have a tremendous amount of equity in their homes, and housing prices are going down just because mortgage rates are really high and there's no activity to speak of. That's very different than in 2008 when everybody had tremendous amount of debt. They were way over levered. They were betting that housing prices needed to continue to go up, and if they didn't, they would have to be forced. If housing prices started to fall, they would be forced sellers, and they would lead to a string of defaults. I mean, that's totally not what's happening now. It's just absolutely not what's happening now. This is more like a pause, like a timeout. Everybody's just waiting to see if mortgage rates come down. And if they do, you'll probably see a pickup in activity. And if they don't, well, the pause will go on, but eventually everybody will just recalibrate their expectations. And you're going to say, hey, if I still have money, I still have equity. If I want to move, I just need to budget for a 7% mortgage rate. Mm-hmm. And should I do it or not?
Yeah. So I remember the movie The Big Short. If anyone's seen that, it is not like that this time around at all. So if there's anybody who has leverage, it's more institutional buyers, which is a smaller percentage of buyers and very isolated in certain communities. So in certain communities, you might have more pain based on the inventory and the who owns these places. But generally speaking, we don't see this as a 2008 type housing issue. So I think that's all we got in the queue here. So we will wait till next month and please be on the lookout for our housing update and a deeper dive on GDP. And thanks for joining. We'll talk to you next month after Thanksgiving.